host, Duncan Fox. Thank you very much for joining us this week. Tonight we're going to be talking about financial assets. Now, there are four main types of financial assets: bonds, loans, stocks, and bank deposits. There are also, due to current innovation in financial market systems, there are loan-backed securities, which we're going to be getting into a little bit in this video as well. So here's the breakdown. Loans are an agreement between an individual lender and a borrower. The high transaction costs that usually come from making these loans can be very good, make it very good option for any sort of small businesses or individuals, because it allows them to go with just the transaction cost of operating with the bank. However, it's not very good for big businesses and governments who tend to use bonds as opposed to loans, because they can reduce the amount of their transaction cost. Bonds are effectively an IOU from the borrower, where the borrower offers an interest rate for the years and then the full principal upon maturity of the bond. It makes it much easier to research bonds, because there are such things as bond rating agencies which find that information out for the consumer for free. However, with bonds, there is the risk of default, where the borrower runs out of money and simply refuses to pay the bonds. Now, it's very easy to resell these bonds on the market, which makes bonds much more liquid than loans, seeing as bonds are very standardized across the entire market, while loans become very individualized for each company and individual they're given to. However, the loans can still be sold on the open market through something called loan-backed securities. It's basically assets created by pooling loans. For example, right before the housing crisis of 2008, there were large swaths of loan-backed securities in the real estate market, where companies would take all these mortgages, package them together, and sell these shares of the mortgages on the open market. Now, while this is good because it allows an easy diversification within each portfolio, it's very hard to rate each individual loan, which is what happened in 2008 when the bubble burst, because no one was able to actually see the value of each of these loan-backed securities. The pool is sold in shares, which means that many people can hop in on this great investment. Stocks are the highest reward financial asset that you can purchase. However, it's also the most risky, because it is taking a part of the ownership of the company. Yes, that's right, you heard me. Stocks are a share of ownership in the company. If you, for example, go and buy one of Disney's shares, you become I don't even know what the number is, 1/1000% owner of the Disney company. It gives you voting rights in the company depending on the type of stock you have, and it also makes you available to profits of the company in the form of dividends. However, stock prices will fluctuate depending on the valuation of the company, but they tend to be very easy to resell. There have been times in the past where it can be more difficult because maybe someone doesn't want to buy it at the price you're willing to sell it, but that's a whole personal finance course that we're not going to get into in this series. Maybe we'll do personal finance later. We'll see what I have time for. Now, stocks allow the investors to split both the risk and the reward, because most individuals are not risk tolerant enough to own an entire company by themselves. They have the highest returns but the highest risks, like I mentioned. Now, financial intermediaries combine these different types of funds into different types of financial assets. You have four main types. You'll have your mutual funds, which create diverse stock portfolios and then sell shares of these portfolios. You do have to pay a fee to manage these, depending if they're chasing just diversification. You'll have a smaller fee. If it's an index fund that's just tracking like the S&P 500 or the Dow Jones, it'll have smaller fees. But if you have someone who's trying to pick winner stocks and an actual manager of the fund who's like taking time out of their day, because that is their job, they're going to charge you a higher fee, right? But again, stuff we'll get into in personal finance. You also have pension funds. These are nonprofits that invest for their members until they retire and then pay out sums of money after retirement. Usually these are paid for by companies that you work for who pay into these pension funds, and then the pension funds pay out for the workers. You also have life insurance companies, which basically invest the money for you and then pay out the owner of the life insurance policies. They pay out the policy to the beneficiaries, named beneficiaries on the policy, should the owner of the policy die while they're holding it. There are also the biggest type that you're going to interact with both in this class and probably in the real world are your banks. They're very complicated, and they actually have their own video right here. So yeah, I'd highly recommend going and checking that out. That's pretty much financial assets. That's all you need to know. There are whole sides to financial assets that we don't even get into in here, because they don't have actual effects on well, they do. Everything has effects on the economy. But these parts aren't important for what you need to know for the economy. But I do think that they are important for you to know, because financial assets are the best way for you to become independently wealthy and save up for retirement. Again, personal finance, completely different course. But for now, this has been Duncan Fox driving away into AP Economics.